Okay, hi everyone. Welcome to Vantage session, right? So for today, we will be covering on identifying breakouts, stops, as well as retracements. So I'll just wait for about 1 to 2 more minutes for more people to join us before we get the session started. And if you guys have any questions as well along the way, right, please don't hesitate to put them under the questions chat. So we'll just give it about 1 to 2 more minutes, right? So for those of you guys who just joined us, a very warm welcome. So as always, right, so for today, on Thursdays, generally it's more educational. So we will be covering specific topics. So for today itself, we are actually covering on breakout stops, as well as looking at retracements. So this one will be covering mainly on breakout, right? So if you guys have any questions, right, do put them under the questions chat. So I'll just give it about 1 more minute before we get the session started. Okay, so let's get the session started, right? So those of you guys who just joined us, very nice to meet all of you guys, right? So if you guys have any questions along the way when we're covering this topic, please do put your questions under the questions chat. Okay, just a quick introduction of myself. I'm Li Xing. I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the Best FX Research. And this is my LinkedIn, right? So if you guys have any questions, right, feel free to reach out to me on LinkedIn. So just a quick disclaimer before getting the session started. The information presented here is not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering. So we will first cover trading range and breakouts, and we will be looking at basically how do we identify breakouts. And then we will be moving on to looking at anticipating breakouts. So for this, we will combine them with market structure. We will also take a look at entries and exits and how we can actually combine them with the strategy that we're looking at. And then finally, we're going to be looking at the ways we can manage these profits from taking this breakout strategy. Okay, so first, as usual, right, if you guys have any questions along the way, right, please put your questions under the questions chat. I do have them open. I have the question as well as the Q&A box open. So if you guys have any questions, right, just put them there. Right, so let's take a look at how we can determine trading range and breakout. Right, so generally breakout occurs when price breaks above or below a key resistance or support zone. So take a look at this example, as you can see here, right? So let's say we have a strong support area over here. So usually in times when prices break up, what we're trying to expect from this is that we're waiting for price to break and close below a key support area before waiting for a pullback, right? Potential pullback to retest it as a resistance. So breakout occurs when price breaks above or below a key level. And what this shows is that there is a significant change in demand and supply. So the idea is that when demand fails, it creates supply. And when supply fails, it creates demand, right? So it's vice versa. So we will go on to specific examples to see how we can actually apply this concept later with euro dollar, right? And when there is a change in demand and supply, it also signifies the beginning of a new trend. And then what's important with breakouts is that we want to take a look at the breakout in the direction of the previous trend. So what we mean by this is that when prices are trading higher, so for example, it's forming your higher lows and higher highs in a bullish direction, what happens is that usually the breakout happens on the upside, because in the uptrend, what usually happens is that you can see that the lows would hold, whereas the highs themselves would be the ones that are taken out. So in an uptrend, you can see that the lows itself should not be violated, whereas the highs are constantly taken out. So in an uptrend, a breakout, we're looking for a break above the upside, above a resistance level, a break above this area, and possibly testing it as support again before it continues higher. It's also showing that the confirmation of the trend still exists, right? So in an uptrend, as we have mentioned, we are expecting the highs to be taken out. So another way you can take a look at it is that the highs are constantly broken. So there is the break towards the upside before it continues on the uptrend. And with this breakout itself, it confirms that the trend is still intact, right? So the uptrend still exists, where price could form your higher lows and higher highs. Breakout in the opposite direction, meanwhile, right, it signals that there is a trend reversal. How so, right? So for instance, if you are looking at a downward trend, right, let's say prices are pushing lower, and the first mark of a market structure, it's always looking at the highs and lows. So in a downtrend, you can see that prices are forming lower lows and lower highs. And what happens after this, it's that this is the last structure, as you can see. This is the last structure that pushed price lower and caused that break in structure. So when there is a break above this area, right, so a break above the resistance area, what this shows with a change in structure, it's that prices could be continuing on the upside. So this is what we mean by breaking out in the opposite direction would signal a trend reversal, right? So more importantly than just looking at breakouts of key support resistance areas, understand the market structure, right? So if prices are in a downtrend, it should be forming lower lows and lower highs. And the last high that took out the low, right? The last high that essentially caused the break in structure. So let me just change the color of the pen so that we're able to denote this, right? So you can see over here, this is the last high that caused the break in the low, right? The break in structure. So as long as the high holds, this high holds, right? The assumption is that prices would continue on the downtrend. But once there is a change in structure with the break of this high, it shows that there is a change in direction of the trend. Okay, and also what's important with this breakout is that we want to see conviction and speed going into this breakout. So if prices are coming into a key support area, we want to see a strong break. This can be represented by strong bearish candle, right? So as we've covered in the topic on Japanese candlesticks, right, the color of the body, or rather the size of the body itself, would represent the buying and selling pressure. If it's a bearish candle, one with huge body and small wicks, it represents strong selling pressure, right? Likewise, right, in this case, what we want to see coming into a support area, we want to see that this breakout, it's captured with huge bearish candles, right? So it shows that there is a lot of selling pressure coming into this area, right? And this key zone itself, you have a lot of sellers basically selling to push price much lower. So these are a few key things that we need to keep in mind when trading breakouts, right? So let's take a look at the next example, or rather the next slide. So now that we have a rough understanding of what trading ranges and breakout means, right? What is the next step that we go to in terms of identifying the breakout? So for breakouts itself, the first thing first, right? The most important thing, as always, I cannot emphasize enough, it's looking at the direction of the trend. This is important because trend, it's always our friend, right? So we want to, as much as possible, trade in the direction of the trend. So when trading in the direction of the trend, there are three things that we can look at, right? So in terms of identifying the market, we want to see whether it's moving sideways, it's moving upwards, or downwards. So in a sideways market, what you should be seeing when you load any trading view chart is that you have clear highs and lows, right? And prices respecting these horizontal levels that you can draw across. So there is no clear highs and lows in this case, right? Prices are respecting both the support and resistance areas. In this case, you can conclude that markets is in a sideways trend. In a sideways trend, right, for breakout strategy trading in sideways market, what we want to wait for, it's a break either above the resistance area or below the support area. So within this range itself, we try as much as possible to stay out of the market. We want to wait for a clear break below, and then to signify that there's more downside, or a clear break above it. Okay, so this is for sideways market. In an uptrend, right, so how we identify an uptrend, we want to see clear higher lows and higher highs being formed. And this is important, right, that we see clear higher lows and higher highs, because the assumption is that in an uptrend, the uptrend is going to continue unless there is a change in market structure. This concept is very important because when we go deeper into this topic, right, when I show you guys example on euro dollar, we will be using this concept, right? So the idea that in an uptrend, the highs themselves would be target, right? So take a look at this example. So let's say if you see a pullback, right, a retracement into this area, in an uptrend, the assumption is that when price comes into this zone and you see a change in structure on the smaller time frame, so let's say your 15 minutes time frame, the assumption here is that this high itself would then be the target. The idea behind this high would be a target is because this high came into a support area. So this high essentially pushed prices into a support zone. But once price enters a support region over here, right, what we see here is that basically this high itself, it fails to break the support area. And how do we know that it fails to break the support area? It's because on the smaller time frame, you're seeing this change in structure. Okay, so again, we will take a look at euro dollar specifically, right, in details as to how we actually apply all these concepts. So in a downtrend, you have lower lows and lower highs that are being formed here. And once again, the assumption is that price would continue forming the lower lows and lower highs, right, until there is a clear change in structure to signify that there is a trend reversal. So sideways, as I've mentioned, you have support and resistance zones that are being respected. So after we have identified the overall market direction, so this is the first step, the next step is to look at key support resistance areas. So how do we identify key support resistance areas? It's basically to look at key zones that prices interacted with multiple times. So if you take a look at TradingView, right, so maybe for this, let me just open up TradingView so that we can explain this a little clearer. So the idea behind this is to look at key zones that price interacted with. Let me clear all these drawings. Right, so if you take a look at any chart, right, ideally on the higher time frame, because the higher time frame would give you the higher time frames in general hold more weight, right? So you see a lot less whipsaw, a lot less of this noise that we see here. So let's take a look at an example, right? Let's say on the daily time frame. So in this example here, right, so what we want to do is to highlight key zones. So specifically here, you can see that this would be a key area, right? So you can see this region, essentially how prices interacted with this zone. You can see this area, right? So price came in, tested this region as a support once. You see that huge significant push up, and then again coming into this region, tested it, broke below this area, pulled back, and you start seeing lower lows and lower highs being formed. You can see here, right? So just in terms of market structure, you can see that in terms of market structure itself, right? So if you're to mark out the highs and lows, you can see that this high itself caused a break in the previous low, right? So this is what we call, or we term, a break in structure. So price broke the low. So this high itself, right, should not be violated. So you can see price came in, right? It did not actually take out the high. It came in and respected the supply zone that we have here. So you can take it at the extreme of this whole move, right? So price came in, respected the supply zone, continue onto the downside, and you can see what happens after. There is a clear support area again, right? This was the support area. Extended across, it became this resistance area on the break. So again, price pushed into the supply area that we have, and then it broke towards the downside, retested this region again as a resistance before going lower. So in this example itself, you can see that when we take a look at key support and resistance zones, right, these are the ones that we're looking at, essentially looking at horizontal levels and trying to see if these are the levels that price came in and interacted with multiple times. So in this region itself, key things to look out for when you identify these zones, it's first, we want to look for significant reaction. What I mean by this is that when you identify this zone, right, so let's say we identify this area here, we want to see price come into this region with a huge move to the upside. And what this shows us is that coming into this area, you have buyers basically entering the market to push prices higher. And then again, on this region itself, you can see that price came in, acknowledges this zone with this bullish candle before a clear break above. And on the breakout of this level, so just now we covered on breakout, you can see that this breakout, it's usually concise, or not concise, it's concrete, right? So this breakout itself is represented by a strong bearish candle. And if you take a look at the candle itself, you can see that the candle, it has has a long body and small wicks. So you can see that this represents strong selling pressure, right? You don't want to have a case where the breakout is denoted by just a small doji, because this shows signs of uncertainty. So there's this tug of war between buyers and sellers, and they're unsure of where prices are. But in this case, you can see that this breakout is convincing, represented by strong selling pressure here with this huge body. Okay, so this is just something to keep in mind when you're looking at candles itself and also looking at zones that price broke out. So after we've identified the key zones, right, the last thing is to wait for a break and close below the key zone. It's important that we wait for a break and close below the area instead of just taking the wicks. Okay, so in this case, right, this is really dependent on your own trading style, right, as well as your trading strategy. But personally, I would prefer to wait for a break and close below, because the idea is that we could see price come into this region and wick below it before closing higher. So in this example specifically, right, I want to show this example. This would actually be on gold. So if you take a look at gold, right, so back in one of our live trading sessions, we called the shot on gold, right? So I'll just load this. So you can see that gold, actually, it's trading on a key level right now. Let me see. I probably will have to switch the template, because this is not the template that we use for the live trading session. So let me just switch the template. Okay, so on the template itself, right, let's see on Go. So Go is actually a good example of how it's, you can see a fake out here, right, represented by the strong move, but you don't have that. Okay, so this is our outlook on Go. So during one of the live trading sessions, we call a bearish move on Go. We highlighted the key levels as well, right? So you can take a look at that recording specifically as to how we got these levels. But you can see what happened over here, right? So essentially on Go, price came all the way down to the support region that we found, this area, and this was obtained from the higher time frame on the daily. Over here, you can see that this was a very clear resistance level with significant reaction of it. And before a clear break above, price came in to test this level again. And then you can see what happened yesterday, right? Following the release of the FOMC minutes as well as US data, this spike over here, right? So this is why it's important to wait for a break and close. You can see that price came into this region. It spiked right below this area, but it did not close below the region, right? Before it continued higher. So this is important as to why we want to wait for a break and close below. We want to make sure that the move itself is convincing, right? And it's represented by a strong bearish candle with small wicks ideally. When you have a case like this where you have small candles, small body with huge wicks, what this represents is that there's a lot of uncertainty. And also, of course, a big part of it is driven by fundamentals. Okay, so this one's not really technicals, but you can see that just looking at the technical levels itself, even though fundamentals drive this move in price, if you take a look at the technicals, you can see that it did respect the support level, right? Price wick below this level, but it fails to close below this region. So there is no breakout of this support essentially. Okay, so this is why it's important to wait for a break and close below this region as much as possible. But again, I would say that it's also dependent on your own trading strategy or your trading style. But personally for me, right, I would prefer to wait for a break and close and a retest of these zones in order to minimize the whipsaws. Okay, so when we're looking at breakout, right, so we gave this example earlier. Let me just clear this drawing so that we're able to see this clearly. So in this example, you can see that the first step is first to look at the market structure. The trend, it's our friend, right? So as much as possible, we want to trade in the direction of the trend. So looking at market structure, you look at the highs and lows. You can see the highs are marked out in blue. So in this case, we have a strong downtrend with lower lows and lower highs being formed, right? So in this case, this is an obvious move down. And then coming into this region itself, you can see that the next step is to identify any key graphical levels. So in this case, I've highlighted this resistance area over here. You can see the support area where price came in with significant swings. You can see this move, right? So price came in, respected this zone, and we see that clear break below. That's one. And then one more thing to note is that I have highlighted this level as a support level, but you can see that the same thing applies as well here. This horizontal level, right? So same thing, price came in, you see that significant move down, price broke below it, retested as a resistance over here, and then pushed lower. Okay, so these are the first two steps in identifying this zone. When price entered into this area itself, you can go down to the smaller time frame. It can be on the M15 minutes. So for this, we will actually show an example on euro dollar on the M15 minutes and possible trades that can be taken from there. So in this example, you can see that once price enters into this region, go down to the M15 minutes, wait for reversal on the smaller time frame before playing the higher time frames direction. Okay, so this is on looking at breakouts in terms of how we can play shorts, right? Looking at the break below key support areas. If you take a look at just how price pan out, right? So for those of you guys who are not that familiar with candlestick patterns, take a look at the line chart. So I've traced out this pattern over here. You can see essentially this is how price looks like here. Price came in, you can see the test as a support region twice and then failed it with a strong bearish breakout represented by this bearish candle over here. You see this bearish candle, and then price retested this region as a resistance, as you can see before going to the downside. So this itself is like one of the support turn resistance type of support turn resistance level that we've covered in the support resistance chapter. Okay, so next one that we want to look at would be looking at a bullish breakout, right? So break towards the upside. So same thing, right? Always establish the direction of the trend first. That's the most important thing, because if price breaks in an uptrend, right, as we have mentioned, in an uptrend, we're expecting the highs to go, right? So the highs themselves cannot break out the low. So what happens is that we're expecting price to push higher and break this highs. So another way you can think of them is that these highs themselves, they are weak highs. So they're constantly targets. They're take profit targets essentially. So the first thing first, establish the direction of the trend. You can see this is an uptrend. Take a look at the lows that are being formed. So in an uptrend, you want to see successive higher lows. So you can see that the lows itself should not be violated. So what this also means in an uptrend, right? If we're not expecting the lows to be violated, it's that if you have an entry, so take this example, you have a clear resistance level, price breaks above this level, so it creates a resistance turn support level here, right? So you can take a potential entry over here. Of course, ideally, we want to wait for, again, smaller time frame confirmation. So this is one, but what it also suggests, right, in an uptrend is that you can see that the low, so once this low itself breaks the last high, it caused that break in structure that we have over here. We are not expecting the low itself to break. So this low itself should not be run, right? So what this also means is that if you are taking a strategy, right, trading in the direction of the trend with support resistance zones, what you can then do is that when price retraces to this level and we have a break in structure to the left, right? So you see a clear break of the previous high. This low itself can be the stop loss. So you can put your stop loss just slightly below this low on the premise that we should not be expecting this low to be broken. If price breaks below this low, there is a change in structure, there is a trend reversal, right? Potential trend reversal, because this low it's broken, that it's also when we want to get out of the position. Okay, so this is how we can actually combine the concept of strong high, strong lows, right? In an uptrend, we're expecting the lows to hold. So if there is a pullback into this region itself, right, you can place a stop loss just slightly below the low, because the assumption is that the trend is going to continue on the upside unless there is a change in market structure. And the change in market structure will come when price breaks the last low that took out the high. So once price breaks the high, we're expecting this low to hold, right? So if this low doesn't hold, then it could signify a potential change in trend. So this is covering more on the stop loss, right? And how we can combine the strategy. But if you take a look at just trading ranges and breakout in general, you can see that there is this resistance area and this is a significant move. So again, I want to emphasize that when we look for these areas, we want to see a significant rejection of these areas. Something like this, for example, you can see that there is this small rejection here. Small rejection. This itself is not a significant move, right? So you want to look at an area where if you take a look at it at a glance, you can see this mountaintop shape forming. So you can see price broke above it, retested this area, and before it continued to the upside. So this is an example of a break towards the upside, and the break comes in here. You can see a clear break, right? So also a key point to note here, it's that it's as much as possible, right? Or rather, it's a good thing to wait for a break and close above this region to confirm the breakout. Because in this example, you can see that when price breaks above it, it actually retested this region as a support once on the immediate break, and then again coming into this area before it pushes up. So you can see that the breakout, this is an example of what we'll call a breakout and a retest, a breakout of a key area that we have and a retest of this zone. Okay, now let's take a look at this example that we have here. So in terms of looking at the methods that you use to identify breakout, personally for me, I look at close prices. So what this means is that you want to wait for a break and close below the area, right? So that it's not just the wick, but the body of the candle must close below a key level. So let's say you have a support level over here. If you see that the wick spiked below it, but not the body, this is, for me, is not considered a breakout. What I want to see is a clear bearish candle, right? So if price comes into a support area, a clear bearish candle that breaks and pierces right through this support region, then this shows me that there is selling pressure coming into this area, right? It's decisive. So wait for break and close below the key zone, and this reduces the odds of being caught in whipsaw. Other ways you can actually filter for breakouts, you can look at a certain pip, right? So take a look at certain pips, so maybe 20 pips below the key support area. So this one you would have to decide, right? So it's based on your preference, or a percent filter. So if you don't want to take a look at pips movement, you can take a look at maybe 1%, right? So if price close 1% below this support level, you can consider this a breakout as well. So these are examples that you can use, right? If instead of looking at just close prices, you can look at pips filter. So you can decide on the number of pips that you want price to trade below or above, right, before considering it a breakout. You can also take a look at the percent filter, right? So it can be 1%, 2%, again, depending on your preference. You can take a look at time filter as well, right? So what this means is that when price breaks below a key zone, let's say a key support area, you want to see price spend time within the key zone itself, right? Within this support area. So on the breakout, you don't want to see a case where price just pushes down. So this example, you can see very clearly, right? So let me clear the example. You can see in this case, right, price hardly spent any time on this level. So price pushed down and the next moment it's just more to the upside. So if you take a look at the 1 hour time frame itself, so let me just clear this drawings and take a look at the 1 hour. You can see that on the 1 hour time frame, it's the same thing, right? So there is no close, right? So if you're using the close filter, you can see that there is no close below this key region. And also if you take a look at the time filter, you can see that there is no candles that basically spent time below this support area. So it was just a strong spike, right, represented by this wicks. But if you take a look at the body of the candles, there's no close that's below the area, and there are no bars below this area as well. Okay, so this is just something else to keep in mind when you are looking at filters for breakouts. And then finally, right, of course, it's from volume. This will probably be more applicable if you take a look at stocks in general, right? In FX, you don't have a centralized exchange, so you're not able to take volume, even though some brokers do offer volume. So if you take a look at TradingView, right, some of the brokers are able to see the volume, but some of them you can't. So for volume itself, right, ideally we want trading volume to be heavy because this represents a lot of activity within that particular level. If you have a small volume, right, coming into a key area itself, but this means that it's probably not very convincing. But there are also research that shows that usually on breakout, right, breakout decreases, on breakout, it actually comes with lower volume. So just something to keep in mind. But in general, when you take a look at volume, right, volume, when you have a breakout accompanied with heavy volume, it more or less confirms the breakout. Okay, so I have a question, right? Do you mind telling me how many times the retest to the support or resistance will give the sentiment of a breakout? I remember a few months back, given many trading indication, the range of 1680, it's strong support being tested many times since even last year, but unfortunately it was broken end of September. Okay, so let's take a look at gold. But in general, I would say that 3 to 4 times, right? Once it started testing 4, 5, or even beyond that, then there is a lower chance that it will hold. So of course, this one you have to run a bit of back test, but I would say that in general, around 3 to 4 times of the retest, right, before the support or resistance area give way. But more importantly than that, right, look at the order flow, right, combine market structure with this. So don't just take it in terms of how many times it tested, but also understand that what is the overall direction of the trend, right? So if you take a look at gold, so let's take a look at gold on 1680. So I believe 1680 is a key level, right? So it's 1680 is this area here. Let me just remove all these drawings and clear this. Right, so if I clear the drawing, let me just put a horizontal line across at 1680. So I believe it's this area. So this is the region. So on the weekly itself, you can see that just in terms of market structure, right, the most recent move, you can see clear lower lows and lower highs being formed. So this is one, right? So the idea is that any pullback itself, when price comes into a resistance area, could continue on the downside. And if you take a look at this support region, right, so this was the support area, 1680, I believe this is the area that you're seeing, the rebound, right? You can see that when price push up, again, the previous market structure is still in a bearish trend. So what happens is that this pullback itself, this push up that you're seeing over here, it's just a pullback into the resistance area. Again, combining support resistance concepts, you can see support, this was the support area, significant push up, and then that clear break below. And when price came back, right, it just came and retest this region again as a resistance. So this 1680 support that we're seeing over here, it's just a push up, right, to continue this bearish market structure, which is why I say it's important to look at the market structure, identify the direction of the trend first, and then you're able to tell whether this pullback itself is actually a change in trend or it's just a continuation of the trend on the higher time frame. Okay, so this is the support area, right? So let's take a look at this area. So you can see that this area itself is a huge area that we have. This region here, right? So there is this support area. So you can see how many times price came in to retest this. The first time price came into this region, actually, if I extend it across, you can see that there is even more tests here, right? So this is the support region. You can see the number of times it has been tested. So this is once. We wouldn't have caught this move, right, because of this huge push up. So this one would have established a support zone for price for us to look into. So this is the first time it tested once on the weekly, second time over here, third time here, fourth time here. And then you can see afterwards, right, price just failed. We tested it as a resistance before it actually whipsawed above it again. So you can see that it's 4 times, right? A test of it 4 times on the weekly time frame before it actually gave way. Okay, so yeah, I hope that answers your question. So in terms of breakout, right, again, take a look at the overall market structure. This is also important, right? Of course, if price tested this particular level too many times, right, there's a chance that it will give way. So in this area itself, okay, so we take a look at volume. So let's take a look at the next slide. So in line with what was asked just now, right? Now let's take a look at how we can actually anticipate a breakout. So anticipating a breakout would allow us to combine, basically we have to combine this, right? So market structure and order flow. So the idea is that in an uptrend, prices are forming your higher highs and higher lows, right? So take a look at this example. So in an uptrend over here, so I'll actually show an example on euro dollar as well. So just understand the original or rather the idea, right? The basic concept first. In an uptrend, higher lows and higher highs, you're expecting these highs to be constantly targeted. What this also suggests is that when there is a pullback, and smaller time frames start showing that demand is taking control, you can play the longs, right, targeting the upside. Okay, so in a downtrend, right, it's the opposite, right? So the idea is that the low should be taken, right? And you want to map out supply and demand areas. So I'll show this example on the euro dollar chart, right? So let's take a look at euro dollar on the weekly and the M15, and I'll also explain how we can combine this order flow, right, and ideas behind why we can take this move. So let me clear the drawings as usual. And let's take a look at euro dollar. Okay, so if you take a look at euro dollar on the weekly time frame, right? So as always, we want to map out supply demand areas, right? So the idea is that when supply zones fail, it creates demand and vice versa. So if you just focus on the weekly time frame, right? This move up here, you can see this recent candle. So this is on the weekly, which means that one candle's movement itself would represent the movement on the week for the week itself, right? So if you take a look at any candle, essentially what this marks is that it marks the open, high, low, and close prices for that week. Okay, so on the higher time frame, it will be less choppy. You can see much clearer movements because it only marks out 4 data points right across that week, as in WEEK. So in this case, you can see that this area itself, right? So again, resistance area, you can see that there is a supply area over here, right? And when supply fails, it creates demand, right? So you can see that price came in. So essentially, if you just focus on this portion of the chart, right? Focus your attention on this portion of the chart, and you can see that how order flow comes in play. So you have supply, right? So understand that there is a supply region over here, this area. Okay, you can see supply. Price came in to tap the supply region once here, and then it pushed lower, right? So on this push itself, when it continues to the upside, right? So essentially it fails this high. You can see that price came in, tapped into the supply region the first time. It created another supply region over here. But what happens is that price broke above this area. So when supply fails, it creates demand, right? So this concept is important, right? When supply fails, it creates demand. So you can see that this is the demand region. Okay, so with that in mind, right, you can see that what happens after that on the weekly, price once again tap into the supply region. Let me just remove the magnet mode. Price taps into the supply region again, and it pushes into the demand area. So what this tells you here is that now you have two areas that prices are trading within. You have a supply region that prices pushed into, and at the same time, right, price react off the supply region represented by this wick. It pushed down into the weekly demand zone. What this also suggests is that on the weekly demand, if we are seeing that there is a change in structure on the M15 minutes, what this suggests here, right? So coming into this demand area, you have basically bearish move down, right? Bearish trend down. So on the M15 minutes, if we are seeing on the smaller time frame, it can be the M30, the H1, or the M15. But the idea is that if you see that change in structure on the M15 minutes, what this shows you is that this high, right? Recall that this is the high that pushed price into the demand area. Okay, so this is an extremely important concept, right? This high push price into the demand area. If on the M15 minutes or the smaller time frame, I'm seeing that demand, it's starting to gain control, which means that your resistance areas are failing and your demand support areas are starting to hold. What this shows me over here, right? We call the concept of strong highs and weak highs. What this shows me over here is that this high itself failed to break the demand area, and this high would be considered a weak high, and it is hence a target. So once on the smaller time frame, I see that demand areas start gaining control, right? So we'll go on to the M15 minutes later to see how this concepts apply. But the idea is that once you see that on the smaller time frame, demand starts gaining control, but it shows you on the higher time frame, it's that this high itself, it's now weak, and it's a potential target that we can take longs and target this high here. Okay, so with that understanding in mind, right? So once you understand this concept, let's take a look at the M15. So recall when price comes into this area, right? This is our focus. And this only works when you have price trading within the demand and supply area. Okay, so you can see that this is within a supply area and there is a demand area. And we found this demand area because price came in and tapped it once. We saw that rejection and it pushed higher, breaking this high. Once it breaks this high, the candle that's still held within the high, it's this candle. So again, this uses the concept of once supply fails, it creates demand. So there's demand area over here. Price came in, tapped into the demand area. Now we want to go down to the smaller time frame because the idea is that when prices on the smaller time frame start showing you that supply zones or resistance areas are failing, it tells me that I can take longs with this high as the target because this is the weekly high. The weekly high that drove price into the demand area. If the weekly high fails to break this demand area, it tells me that this is a weak high and I can target this. So I can basically take longs and use this as the target. Okay, so with that concept in mind, let's go down to the smaller time frame. So this area over here, let's go down to the M15 minutes and you can see this change in structure very clearly on the M15. So I'm just going to zoom out higher. Okay, so this area here, so you can see, so essentially what happens, price came in, it taps into this demand, right? So we have this demand area. Before that, right, let me just mark out the weekly high first so that we're able to get this. Let me just zoom in here. So you can see that this is the weekly high, right? So explaining what we did earlier, right? Nothing changed. I'm just going to mark out the weekly high and this is the weekly high. Okay, I'll mark this out as the weekly high with the understanding that if demand areas, right? So if price enters into this weekly demand and you can see that support zones are starting to hold and resistance zones are failing, it tells me that this high, essentially the high that drove price into the demand area, it's a weak high, it's targeted because it fails to break the demand, right? And how do I know it fails to break the demand? It's when the smaller time frame starts telling me that there is a reversal on the smaller time frame. It can come in the form of change in structure on your M15, right? So a break of the last high because it should continue on a downtrend, but there's this change in structure on the smaller time frame, and then it tells me the higher time frame, this high itself is a weak target. Okay, it's weak and hence it's a potential target. So this is the weekly high. So this is the weekly target. Now let's go down to the smaller time frame. So when price taps into this region, which is this area here. Okay, so I will be focusing on the M15 minutes when price enters into this demand area. Okay, so let's see, right? So let's trace back. So price entered into this demand area. You can see it comes into this region here. So you can see again, coming into this demand area, recall this is the weekly demand area. Coming into this demand area, you can see very clear lower lows and lower highs being formed. You can see very clear lows and highs. And then what you want to do next is to mark out the last low last high that we have, right? Because the idea is that in the downtrend, recall in the downtrend. So again, this goes with the concept of lows and lower highs. In a downtrend, we're expecting the highs to hold, right? Because we're expecting price to basically just retrace and continue on the downside. The high should not be violated as long as there's a change, as long as it holds. So in a downtrend, you can see lower lows and lower highs coming into this region as well. And then what happens over here is that you can see price comes in, it forms a new high. But this high itself did not break the low, that's one. And then what you can see subsequently is a change in structure. You can see this high here. This is the last high that we have. And there is this change in market structure with a break of this high. You can see this high. So if I were to just draw a horizontal line across, taking the wick of this high, you can see that where did the break come in? The break came in over here. You can see the break and close above. Right, so recall we want to wait for price to break and close above. This itself is not considered a breakout, it's a wick. So it's not considered, right? We want to wait for a clear break and close above, represented by this move here. You can see that clear push up above it, and it's a convincing push. It's not one with a small candle, a small body. Okay, so price push up and broke above it, it broke structure, and then you can see subsequently it actually came back down. And what happens is that it respected this demand area. You can see this support zone. Let me just remove this. You can see I'll just draw a horizontal line across. So ideally we want to use a zone, not just a graphical level, right? But the idea is there, right? So you can see this support area. Okay, so this blue zone here. So this is the first sign that demand area is being respected. You can see very clear again, significant move. there's a sharp reversal, a break above it, and then a retest of it as a support before it continue on the upside. This is the first sign that there is a change in trend, right? And recall that when there is a change in trend on the weekly time frame, where is our weekly target? Our weekly target is much higher, right? It's this zone that we've marked out. It's this high. This is a weekly high because this is the high that drove prices into the demand area. So once demand starts gaining control on the smaller time frame that you're seeing over here, it tells you that this high itself is a weak high, right? Because it failed to break the demand area, which is this gray zone that we're seeing over here. So I hope that this concept is clear, right? Because it's very useful when you apply it across the different charts, right? You can apply it on euro dollar, right? Other currencies as well, on Aussie dollar, right? Similar setups. So in this case, you can see that, of course, this is the first sign, right? You might not have gotten this demand area. But the idea is that once you see this area over here, what it shows us is that there is bullish order flow coming in play. It also shows us that we can take long positions as long as this target has not been reached. Okay, so you can see that then you can apply the normal support and resistance concepts. You can see this area, right? So the most significant one would be this one over here. This area, you can see this area here. Price came in, there's a clear resistance area. The high of this. Okay, so you can see that there's this resistance zone, right? So again, you want to highlight it in zones instead of looking at a specific level, but I don't want to highlight too many zones so that it's, it's not it's confusing. But the idea is that you can see basically there is a resistance area over here, right? And then price broke above this region. So recall the concept of combining breakout and order flow. You can see in this case, right? So what would be ideal if you do want to take a long position from here is to wait for, again, a break and close above this resistance area. This is taking trading with the idea in mind that this high, it's the high weekly target, right? So when you take this move itself, you can see that when price breaks and close above it, this now serves as a support region. What is the last move? What is the last low that actually caused that break? You can see that price pushed up, and then this is the last low that we have that essentially broke above the structure on this area. So this, you can see how these concepts are applying, right? So price broke above it. So what this should show is that in an uptrend, this low itself should not be violated because this is the last low that broke the high to the left of it. So as long as this low holds, right? So you can take an entry from here, right? Once price breaks and confirm, there's a breakout confirmation with the break and retest of it as a support. You can take an entry here, stop loss, just below this low, because the idea is that this low itself should not be broken. If it breaks, right, then we know that this uptrend, it could be reversing. So that's why, right, we can take a stop loss here and then targeting this high. Okay, so this is the general idea, right? So there are a few ways you can enter, but the idea is really understanding the order flow first, right? Helping us to identify these targets. Okay, I have another question, right? Thanks for your previous reply. My second one is that when you said supply failed creates demand, does it mean you can only find the supply zones first to see if the zone is changed to demand? You shouldn't find the demand zone correctly first, right? So yes, you always look at the interaction between supply and demand. So in this example, because it's in a downtrend, you can see that the supply zones should hold. So the original thought process, when price comes into this area, you can see that this is again back onto the weekly chart that we showed. So you can see here, right? So in a downtrend, supply zones are expected to hold, right? So you can see this movement. So you can see this supply chain going on here. So in the downtrend, supply zones are expected to hold. They're expected to be respected. You can see that each high that took out the low, right? They're not expected to be broken. In this case, this high, this supply zone was not tested, but you can see basically the extreme of each candle, price came in, right? It's supposed to hold on this area. So essentially, right, this is the idea. So you can see that supply zones are expected to hold, but once price breaks above this region, this area here, you see that price came in to interact with this. It acknowledges the supply zone the first time and then a second time, but within the area itself, you can see that it then creates a demand area because this demand area was the candle that still held within it before we saw the break of this high. So it creates a demand area, right? But we wouldn't know if prices are going to go upwards or if it's just going to continue to the downside. How we would know whether it's going to continue to the downside or whether we're going to see a reversal, it's going down to the smaller time frame. Once the smaller time frame tells you that demand is in control, it tells you that this supply area will not hold because the high that pushed or drove prices into the demand, right now this high then becomes a target. So we could take long positions targeting this move. Okay, and this is a conservative move. Of course, we're not going to be holding the move all the way up here. A lot of it is on hindsight, right? But that's the idea. Okay, so if we take a look at, let's say, other setups, right? Let me see if we have something like similar on Aussie dollar, right? So let me just remove all of this. Yesterday I saw something similar as well. So let's see. Yeah, I believe this is the area. So you can see over here, right? So again, supply and demand area. So this is on a 4 hours. So as much as possible, go on to the higher time frame because it shows you it's less choppy. So in this area, you can see again, right, supply and demand area interaction. You can see there's demand. Let me just remove the Ichimoku cloud so that we're able to see this clearly. So there's demand, right? And then when demand fails, there's supply, and when supply fails, it creates demand. You can see supply, right? Supply fails, creates demand. You can see the demand area over here. And then again, the same thing when you move towards the right of the chart. There is again supply. And then price held before it wick above it, creating demand. You can see this area. So again, right, just looking at this, right? So first you identify the range. There's this tug of war between supply and demand. Price came in, tapped into the demand area, as you can see over here. So when price tap into the demand area, right, and you see the smaller time frames, demand start to gain control. What this tells you is that this high itself would be one target, right? So this is on a 4 hours time frame. So with that idea in mind, right, what you need to do is just again go down to the smaller time frame, check if there are any demand areas that are in control once price enters into this gray zone. So you can see this area itself. You can see again, right, if you go down to the 15 minutes, when price enters into this gray zone. Let me just, where is that gray zone? There we go. So this is the gray area, gray zone that we have, right? So there's supply, and then price entered, pushed down into the demand area, right? So as usual, you want to mark out the high. So this is the high that we have, right? This is the high because this is the high that drove prices into the demand. It drove price into the demand area, as you can see over here. Just get this marking, right? So it drove price into the demand area. So again, right, when price comes into this area, what is the last structure? So in this is the M15 minutes time frame, you can see this area itself, the last high, right? So in this case, this is not that clear. You can see that bearish move down. Okay, so this is the last high. Price came in, tested this high. You can see the high that broke structure here. This high, because this high took out the low. So probably this, in this example, we'll have to go on to the 5 minutes to see it more clearly. But you see the idea, right? The change in structure. So on the 5 minutes, you can see very clear movement. Again, coming into this area, you have lower lows and lower highs. You can see lower lows and lower highs, right? So given the fractal nature of the markets, right, these patterns are going to keep repeating itself. You can see lower lows and lower highs coming in. And this is the last high. Price broke above the last high. We tested this area. So this is your breakout, right? So if you take a look at breakout strategy, basically a breakout of the resistance, a retest of it as a support before it continues to the upside. Once there is this change in structure that you're seeing over here, right, this is the last low that you have that essentially broke the high. So essentially you can put your stop loss below this low, right, on the break of this strategy. So entry can be somewhere here and the stop loss below the low, targeting this high. Of course, anything to the upside in this case, right, you'll have to combine higher time frames order flow. But the idea is that understanding that just looking at just these two candles on the 4 hours time frame and understanding that when price comes into a demand area on the gray zone that we have, right, and demand starts gaining control, what this shows you is that this high that drove price into the demand area itself, this high fails to break the demand, hence it's a target. Okay, so I hope that's clear, right? This is a very useful concept that you can apply just looking at price action and understanding the smaller time frame, right? You can see that it's always the same pattern, right? We don't change our analysis. The idea is always the same, going down to the smaller time frame, trying to find this change in structures. Okay, so yeah, I briefly covered on exits and entries as well with this with the example that we saw on euro dollar and Aussie dollar, right? So again, right, I want to emphasize understanding order flow. So I've explained this with the looking at the highs and lows and interaction between demand and supply areas, right? And also looking at the different time frames, looking at the change in structure on the 15 minutes. You saw this example on euro dollar on the 15 minutes, and then we saw an example on the 5 minutes as well on Aussie dollar. So you can see that the time frame, right? So looking at the time frame itself, it's basically just a smaller time frame. You can use the 10 minutes, the 15 minutes, the 5 minutes, as long as it shows you clear structure. Okay, and then for exits itself, so now that we have pretty much found how the entry is like, in terms of the exits, you want to make sure to trail your stop loss, so you trail your profits. So the idea is that once we have secured the profits, right, prices are moving in our favor. In this example, you can see that price actually moved way above, right, beyond this profit target. But the idea is that when price comes into this region, right, so usually how I would trail it is that you can see this area. So let's take this example. You can see that this is the support, right, or this is the breakout. So on the break of this move, it came and retested as a support. So this gives us a potential entry, stop loss covering the low, because when price breaks above this high, we're not expecting the low to be taken. If price breaks below, right, that's when we know that we are long, so we are wrong. So imagine this situation, right? If we have a case, let me clear all drawings. So imagine a case where we see price breaks above this, right? It gives us the confirmation of a breakout and then it whips below. This is where I want to put my stop loss here because I know that I'm wrong. I want to get out of the trade. So in this example, you can see here, right? Once price continues on the upside, what you want to consider is trailing your stop when this level. So you can see that this area itself is the area that drove price back into the support area. So once price breaks above this region, then this is when you want to consider taking partials or even break even on your position. So the idea of break even is just moving your stop loss to your entry so that you don't end up incurring any losses even if prices turn against you. Okay, so yeah, just something to keep in mind, right, when you're taking trailing stops, right? So you want to ensure that you are taking partials. So a lot of it is really more on trade management than the trading strategy itself, because there are cases, of course, in good examples, right? In this example, you can see that price actually went way beyond the profit target, but there are also cases where you can see price came in, tap into a supply area, and then just continue on the downside. So as long as we're in profit, we want to ensure that we are managing the positions well. So yeah, so and then I also covered on how we can identify the stop losses, right? So using the same idea. So it's always about combining order flow, understanding market structure, right? And once you understand that, you can see you can confidently put your stop loss with the idea that it's not that you're not going to be stopped out, but if prices did hit your stop loss, you are wrong. You want to get out of the position. So the stop loss should act as a protective level, right? So that if you're wrong on this idea, you want to get out of the trade. Other areas other ways you can trail your profit would be based on moving average or you even using ATR. So ATR, it's average true range. So average true range itself considers the volatility. So when prices are more volatile, then you can see that the average true range will increase. So in this case, it's slightly more dynamic, right? Instead of just a fixed value, it takes into account the price movement as well, right? So if prices are swinging wildly, you want to ensure that your stop losses are slightly further away to consider this price volatility. Okay, so yeah, so that's on trailing entries as well as profit targets and trailing stops. Right, so let's take a look at the ways we can manage profits, right? So as I've mentioned, right, so there are a few ways you can actually manage your profit, right? You can either trail it based on a specific indicator like moving average, right? If your price cross below it, you want to get out of the long position, for example. You can also take a look at, for example, looking at key zones. So in this example, you can see that when price, so let's say if you're trailing this position, what you want to do is wait for a break above, right? So if you're taking a long position here, you want to ensure that when price, let me just clear this move, right? So remember this picture here, right? So I'm just going to put back the levels and knowing that this is our target. So let's say when price comes into this region, right? You see you have the entry over here based on just support turn resistance turn support level, the breakout confirmation. And then when you enter this position, right? You want to ensure that when price comes into this area or it breaks above this area, you're actually trailing your profits. So you can trail it based on a key level. So when price breaks above this area, you want to move, for example, your stop to break even. So move it up to the place where you entered. So essentially when price goes against you, you want to ensure that you're getting out or minimizing the risk that it's involved, right? And also when you have it on break even, so when you have lower risk, right, you're able to add in more positions as well because the rest of your trades are basically with no risk. Of course, the disadvantages of trading this is that if prices did move up in your favor, right, and you have sharp movements that's involved, right, you could be taken out of the trade before prices move in your favor. But generally, if you trail it according to market structure, so you can see, for example, this move, right, even if I were to take a look at it on the 5 minutes, you can see that this is the low, right? So in general, when price breaks, you can see price breaks the high over here, right? So this high should not be violated. So it's a good thing to trail your stop losses below key support resistance areas, because what this shows is that if price breaks below this area, this is when you know that there's a potential change in trend. If you're long, you want to get out of the position. So this is another way you can think of it, right? So don't think of trailing stop as a bad thing. Think of it as a way that it can protect your position. So this is on trailing stop, right? Of course, you also want to look at the trading strategy as well as the time frame for the entries. In general, if your entries are on the smaller time frame, then this is when it can be trickier, right? So you want to make sure that you're moving it to break even faster, because on smaller time frames, it can be more noisy. Okay, so this session took a lot longer than expected, right? So thanks for staying with us all the way, right? So just a summary of it, right? So let's we look at trading range and breakout, right? So both continuation and reversal. So idea is to first establish a prior trend. If it's an uptrend, the breakout to the upside, right? It shows continuation of the uptrend. We also take a look at methods that we use to identify breakouts, right? So these are basically key zones. So looking at the interaction between demand and supply. And then once we have that interaction, we're able to establish the order flow, right? So that's the example that we showed on euro dollar, right? So make sure that you're very clear with this concept, because this is a very useful concept that you can use in price action trading. And then also we look at anticipating a market breakout. So looking at market structure, understanding order flow, right? Understanding the concept of strong and weak highs. So this example, we look at it specifically on euro dollar. We also look at entries, exits, and stops, right? So how we can combine them with breakouts. So entries in general on the smaller time frame will give you the confirmation. We saw this example, right? Euro dollar with the 15 minutes and then Aussie dollar with the 5 minutes. Okay, so the smaller time frame will give you confirmation, given that it gives you an idea whether this demand area is going to hold or if it's not going to hold, right? So if you identify, let's say, a 4 hours demand zone, how do you know if it's going to hold, right? By going down to the smaller time frame, looking at the change in structure. We also look at ways we can manage profits, right? So there are a few ways you can do this. This is more discretionary. It's also dependent on your trading style. If your entry is on a smaller time frame, you want to consider protecting your profits more aggressively, right? Because it gives you a higher risk to reward ratio, right? Much higher, because if your entry is on a smaller time frame, you can keep your stop losses tight. So yeah, it's just something to keep in mind. Right, and then yeah, so I have a few questions, right? Do you prefer to use RSI on a smaller time frame over trailing stop to the take profit when it's near 80 or 20? Okay, so to be really frank, right, in general, I don't really use indicators. I look more at price action. So if you take a look at RSI, right? So RSI, it's just using the overbought, oversold region, right? So if I'm trailing the stop losses, usually what I do is that I trail it according to the structure. So as I've shared just now, right? So it's more on market structure. I haven't actually experienced or experiment using RSI as a trailing stop. So that would not, I will probably try it right after this. But in general, for trailing stop itself, I trail it based on market structure. So, okay, so to take profit when it's near 20 or 80. So something else to note about RSI is that RSI itself is an oscillator. It measures price changes with respect to its previous price, right? So it shows that momentum could possibly be slowing, right? Whether it's 80 or 20, depending on what's the direction of your trade, right? So if prices are in an uptrend, then when RSI approaches 80, right, and it exits the region, so not just only approaching 80 but exiting the region, it's important, right? Because in a trending market, you can see that RSI can stay in trending markets, right? In trending markets, RSI can actually stay in overbought and oversold region for prolonged periods of time. So which is why, right, it's important. You can see over here, right? So in a strong trending market, even though RSI actually exited the region, you can see that prices are still trending upwards. So which is why I would say that, like, in general, right, what you want to do first, if you want to look at RSI, look at the exit of the region. So exit of the overbought region or exit of the oversold region, right? This is it signifies potential reversal. Okay, so yeah, so if you're in an uptrend, then you want to look for exit of a 80. So if you're long, you want to look for potential exit of the 80 region. If you are short, you want to look for potential exit of the 20, right? Because when price exits 20, right, it shows that there could be potential reversal. Even though I would say that RSI generally is used more in ranging markets than trending markets. So just something to keep in mind when you're using RSI, right? So if you're trading, you want to make sure that as much as possible, you're in a ranging market. I won't use it to trail my profits in trending market. Okay, so I'll be using the targets as we've mentioned, right, in terms of the key levels. Okay, good morning to you as well, right? So if you decided to take a long position, the entry point should be above the key resistance level. Yes, so if you want to take a long position, you need to first wait for a break above the region first, right? So apart from just the whole example on order flow where I talk about it on euro dollar, right? If you're looking at it just specifically like this, right? Look for a break above the resistance, a clear break and close above to confirm the breakout, and then the retest of it as a support. in terms of the stop losses, you want to put it below the next key level, because the idea is that once we have a break in structure, this low itself should hold, right? If it doesn't hold, we want to get out of the position. So that's why you want to put your stop losses just slightly below this area, right? And the entry can be on the break and retest. So we need a break and close above to confirm the entry first. Okay, so I think with that, we have come to the end of the session, right? I would very much love to take more questions, but I think we have another session going on as well, right, at 5 p.m. So if this is the topic of interest, right, I will continue covering something similar for next week on Thursday, right? So do join us for next week's session as well. We have a price action trading masterclass as well. So this one, we will go deep into supply demand areas. We will go into how we can basically combine all this order flow concepts, market structure, right, to take entries. We'll also be reviewing setups. So I'll be showing you guys entries that we can take as well as the thought process behind them. Okay, so with that, we have come to the end of the session, right? I'm glad that this is such an interactive session and you guys are asking so many questions, right? So this is awesome. So if you guys have any, you want to check out the schedule on Vantage, right? Just go to vantagemarkets.com/webinars. We have the schedule as well as the speakers there. If you have any other questions, right, do email to vantage@markets.com with regards to funding of accounts. If you have any other things, right, regarding the content of this trading, this webinar, right, you can also feel free to reach out to me on LinkedIn. So this is my LinkedIn, right? So if you guys have any other questions after this session, right, so feel free to reach out to me on LinkedIn here. Yeah. So yeah, so I think with that, we have come to the end of the session, right? Thanks everyone for such an interactive session, and we will catch you guys again next week. Tomorrow.